Welcome to today's CPE Study Circle meeting on OECD BEPS Action Plan Report and Tax Treaty Amendments through Multilateral Instrument. The speaker for today is CA Pankaj Sanchetti. May I now welcome the speaker to the dais. Cannot be copied to the printer.
No, it cannot be copied to the printer. What I can do is even if I print here, I can
Wi-Fi we have to take 10 minutes.
generally should have, because this is the long.
No, that's it. We will give you.
There was at least
Let us raise for ICA mode. Thank you. The speaker for today, Mr. Pankaj, he is a chartered accountant. He also holds a bachelor degree in commerce. Pankaj is a partner in PricewaterhouseCoopers transfer pricing team with over 14 years of professional experience in the field of corporate taxation, transfer pricing, and regulatory matters. Pankaj has served a wide range of Indian and global companies in different industry verticals. Pankaj represents regularly client cases before tax authorities, APA authorities, and tax tribunals. Also, he is extensively involved in advising foreign multinational companies on Indian inbound investments, tax-efficient financing and repatriation structures, transfer pricing planning, documentation, and controversy management in India. Further, he has advised Indian headquartered clients in managing their tax structures, including outbound investments, global transfer pricing strategy, and evaluation of alternative cross-border operating structures for the business. Over to the speaker.
Thank you so much. Good evening, everyone. So we have a very small, cozy gathering. So since we have a small gathering, we can be little informal, we can be flexible. So I would be happy if you also interact. So I was just checking, he was saying that the subject is dry, so that's why maybe people have not really registered. But let's try to make it interesting. So, and feel free to interrupt me anytime you have any point to make or any question to ask. I'll try my best to answer it. So, before I start, maybe I just want to give a little background and maybe ask you also, how many of you have heard about OECD BEPS project? So almost 50% of us. So I think we can be very, very basic. 50% of have heard. So where did it all start this whole BEPS project? Where it all start? I think it started somewhere in the 2008 financial crisis. So after that financial crisis, government had to spend a lot of money to revive their economies. But at the same time, their own taxes inflows were falling down. So, but some companies were making good money. So then the OECD and the G20, tried to, G20 in particular asked OECD, why is that the country's taxes are falling when some companies are making huge profits? How are they able to do it? Now, they are able to do it. It was legal, it was nothing illegal, because it's all known what companies, the big companies in the world, what structures they had put in. It was all known. So it's not something like, so there were a lot of numbers being thrown that so much 100 billion worth of taxes are getting avoided because of OECD, because of BEPS and other things. But not all of that 100 billion would be because of actual legal tax planning. Okay, a lot of it could be also because of other reasons, which could be money laundering or evasion. So I don't know how the numbers came, because the OECD also just doesn't give much the source, but it says based on estimates of interacting with various countries, they have given this estimate. So how many of you have heard about tax haven? You have heard of tax haven, right? So it's actually, so BEPS and tax haven, both are misnomers. I mean, BEPS is base erosion and profit shifting, but the whole thing is anti-base erosion and profit shifting. So it's not BEPS reports, it's anti-BEPS reports. So similarly, tax haven, so it's like a tax port, that means, but it's actually literally a heaven. So what's a heaven? So if you imagine heaven, how it should be? How it should be if you imagine heaven? So if I close and imagine how it should be heaven, so it should be like a nice beach resort kind of a place where you get a plate, idle around, do nothing, have your food by the beach, and then relax. You do gambling. And finally, the most important thing, you don't have to pay taxes also. So these places are literally like this. These all places which are tax haven are literally like this. They are really heavens. So these were actually tourist destinations, but they were so small tourist destinations that not even much people were coming up. So then they thought that, why don't we do something different to ask people to come here? So there was this one building in Cayman Islands which became very famous. I'm not getting the name, which was with C something, which had some 18,500 companies in one address, one building, one address having 18,500 companies registered. And because of this, how any big MNC structure, how it looked like? It looked something like this. All zigzag. I mean, there was a lot of tax planning possible. All the countries which were the major countries where profits could be made, everything, had tax rates upwards around 30%. Average was 28, US was at 40, but average was 28, 30. So if you could do some planning, you could basically save 30% of your earnings. Okay, so you had all this kind of structures there. Now, so this all structures, everything was studied in depth by the OECD and the G20, different committees. So OECD reports itself, just the OECD reports, the 15 reports, just if you study those 15 reports, something like 2,000 pages. And then they had come up with drafts. They had come up with clarifications. So there is so much research, study, everything was done. And they studied each of these structures. So it's very difficult to capture everything in this 3 hours. We have limited time, so we will not really study everything, but at a high level we want to understand what is this all about. And then we will go to the MLI. What does the MLI mean? So there are some terms which are being used in the abbreviations, some which are being used significantly in the slide deck. So I'll just summarize this. Some of them are new. CTA is a covered tax agreement. So we have MLI is multilateral instrument. So we always had DTAA. Now we have an MLI. PPT is not a presentation, PowerPoint presentation. It is principal purpose test. MAP mutual agreement procedures. CFC is controlled foreign cooperation. So just before we go, are all of us comfortable with these abbreviations? You know what these abbreviations mean? Because we will be using it significantly in the next slide. So if you don't know, we can just spend a minute or something to capture it. LOB. Action plan is the BEPS action plan. So anti-BEPS action plan. And these reports which had come after the this BEPS project are called the BEPS action plan reports. Fine.
Limitation of benefits.
Yeah, limitation of benefits. So this is a clause which comes under the treaty, which is already there in current treaty also, a lot of treaties, but it's significantly amended in the MLI. So limitation of benefits is when you take treaty benefits. Okay, it is, so what does limitation of benefits clause mean is it's not available to everyone. It is subject to certain limitations. So what are those limitations? We will look at it. So the whole BEPS action plan was on 3 core principles: coherence, substance, transparency. Now, why did BEPS happen? BEPS happened because there was no coherence. Each country had their own laws, tax laws of taxing countries, taxing residents. The double tax avoidance agreements itself, as the name suggests, was with the purpose of avoiding double taxation. Okay. Now, so one extreme was you're getting double taxed. So to move from that extreme, they had treaties, double tax avoidance agreements, and then you had the country laws. Now slowly it started moving to another extreme. So double taxation to double non-taxation. So that was happening. And why was this happening? Is because of there was no coherence in the laws. There were gaps between 2 countries' laws. India, I wouldn't say it was affected that much from the BEPS, except for the digital economy, which has a different aspect. So we will cover that also. But a lot of these countries which were open to business quite freely. So you go to the European Union, it's very open. So people work in one country, stay in other country. A lot of easy cross-border movement of goods, services. So those countries where it was significantly impacted. But there are a lot of areas where India is also impacted. So how do you stop coherence is basically through the reports. They identified where this coherence was missing, and they tried to get the coherence in those things. But they said that this can happen primarily by changing the domestic law. It cannot happen through the treaties, because the companies are using the mismatch in the domestic laws. They are not using the treaties at all. They are using the mismatch in the domestic laws to avoid taxes. So this can happen only through. So we'll spend some time here because we should know what these 15 action plans were there, and then we will be able to appreciate what the MLI is there. So the action plan 1 was the digital economy. Because if you look at the top companies who were misutilizing this provisions or treaty provisions, or maybe moving profits to low tax countries, were the digital or the new technology companies. So who were there? Yeah, so there's Amazon, there is Google, there is Microsoft, there is Apple. So these were the top. I mean, these companies could easily do it. It's not that other companies were not doing it, but these companies could do it because in the digital, you don't need you can do business. anywhere. You can sit here and you can do business in US. It's quite possible. So just to give an example, I mean, from here, actually, if you can use the Uber app and you want to book a cab in Singapore, you can book it. So quite easy. Like you book a cab from here to go to your home. You can, if someone of your relative or someone is there who's gone there, he doesn't have a Uber app. You can tell him that, tell me where are you, I'll book you a cab. Quite possible. So digital economy gives that flexibility, and because of that, a lot of business. So action plan 1 was on studying the digital economy. So very important that action plan 1, they did not close, the action plan report did not give concurrent or a clear action plan how to stop digital economies. They said we'll follow up with the further reports. They give interim recommendations. They said in an interim you can do these things to stop it, but also said that the other action plans also could take some of the digital economy taxation issues, they could solve it, but for completely solving it you will take some more time. They had also come up with an interim report. I'll just move to a news. Interim report which was really recently came up, maybe 3-4 months back, and then their final report is expected by December, which will give clear guidance on how the digital economy taxation rules can be solved. Action plan 2. So what I'll do is maybe I have slides on all these, or each of them. So maybe I'll just wait a minute. Maybe you can just look at it and just see what are the action plans. There's a slides on each one of them. So action plan 2 is hybrid mismatch arrangements. Action plan 3 is CFC rules. Action plan 4 is interest deductions. Action plan 5 is harmful tax practices. Action plan 6. So now the substance, the one which the action plans which reinforce substance. So we were having paper companies, shell companies. Okay, so where treaty was being abused in certain cases, and then you would have shell companies where there was no substance, but you could park huge profits there. So it was just in contracts you could create profits and you could park there, but really was profit being generated there? No. So some of these measures, which is the substance one, they got the solution for them was given, and we'll look at it. One is that how do you stop treaty abuse? The second is how do you company stops avoidance of PE. Okay, so that's the two. So for both of this, the treaty has amended, and the treaty has amended, so that's in the MLI. So how did they try to amend the treaty? Also we'll look at it. That's in the MLI that happened. And on transfer pricing, they strengthened the transfer pricing laws. Okay, that was through the changes in the OECD transfer pricing guidelines. Okay, and the changes that have all happened, almost 100 countries were part of it, including India. So it is not just OECD has changed, so we don't have to worry, India is different. India is also following the OECD. India was part of it. India gave its own comments. There were a couple of places where India said we don't agree to what the OECD guidelines is also saying. So it's applicable in India also. Now, the third pillar on which the whole BEPS action plan was there is the transparency. So a lot of data is available to the taxpayers, but the equivalent amount of data is not available to the tax officers or the governments. So to make them also more equipped, there are certain provisions and which will give them more information. So these were the action plans on the improving the transparency. Now, does all these changes, does it impact India? Do we really have to read it or know it?
Yes.
You have to know it?
Yes.
Have you used any of this in maybe the recent past to advise your clients or in your work? Have you used it? Do you feel so? How many of you feel so you have used it? You have not used it. So I think, I'm not sure, but I think we are using it. A lot of changes that have happened in the domestic law is because of this. We may not know the background of it, but it is because of this. And the next slide has those changes. So what has happened? These are all things that have happened after the BEPS reports came in. So what has happened? And these are all, most of it are from the recommendations. And then there is also a circular by the CBDT where Indian government has said they are committed to implement all other BEPS action plans also in addition to what they have already implemented. So just spend a minute or couple of minutes here to see whether we have heard of these changes or not. Taxation of indirect transfers of assets deriving their value from business assets in India. Indirect transfers. So this has become famous because of the Vodafone case. But the 50% threshold. So previously they said everything will tax it. Then afterward, next year they changed it and they said 50%. The 50% threshold is actually coming from the OECD BEPS action plan. Equalization levy.
Google tax.
Yeah, Google tax, because Google is the biggest company which gets impacted by this. So for digital services, particularly in the advertisement field, if you are paying more than rupees 1 lakh, you have to pay an additional tax which is called the equalization levy. Three-tier TP documentation. So previously we had only the local TP documentation, master file and CBCR. New forms, reporting, everything has been introduced. Obviously, of course, there are thresholds. It is not applicable to all companies, but that also has come up because of the BEPS report.
What is the threshold of this?
CBCR?
Yeah.
CBCR, the consolidated turnover of the group should be more than 5,500 crores. Then it is applicable. Group.
But then this 286 reporting has to be done by the company, that is.
Yeah, so 286 reporting has to be done by the ultimate parent.
Ultimate parent.
Okay, so if the ultimate parent is not in India, then you have to report who is the ultimate parent, which country did it file the CBCR. So you have to give the which country it filed the CBCR. Because this TP documentation, local file, master file and CBCR, the OECD recommended that if you introduce for everyone, it will become too much. Okay, and then they also studied that 90% of the tax planning that's happening worldwide is by these companies which are having turnover above $750 million. So if we cover those, 90% of the problems get solved. So they said, okay, fine, smaller ones we will leave it for now. So it is not introduced to everyone. Master file also, if the group turnover is more than 500 crores, it's applicable. But local TP documentation, it's applicable to anyone having more than 1 crore of international transaction.
No, the only issue is as a local, because I read through that, I could understand OECD, BEPS, that's why I came here.
Okay.
The whole issue is we are on the income tax law and the practice.
Yeah.
When you have to apply, because you don't know what is being filed by them.
Correct.
Whether it is applicable to the group or not also is not known to us.
Correct.
Probably you are only a small piece of portion in India.
Yeah.
As you rightly said in the beginning, they may be there all over the globe.
Yeah.
And knowing that information by tax auditor is impossible.
True.
The only thing you can do is seek the information and say whether it is done or to be done.
Correct.
Applicable, not applicable.
Yeah. So CBCR, I mean, it's so TP documentation every company has to maintain. Okay,
Yeah,
having
no
international.
problem. I think there is
Master file. Yeah, so I'm just trying to say what is the compliance they have increased. Master file, one company in the group is okay. So if in India they have 5 companies, everyone need not prepare it separately. One prepares and it says that I am preparing for on behalf of all these companies and files it, it's okay. CBCR, one company in the globe. Okay, not even India they have 100 companies. It's if the ultimate parent company is overseas and it's filing overseas, that's sufficient. You don't have to
Only
separate.
that we don't have some exchange of information with a particular country.
Yes. So where there is a technical failure, because where India does not have a treaty with them, India has three kinds of treaties. One is comprehensive treaties, where you have all the different kinds of income covered. Second is limited treaties, where I don't cover all types of income, but certain limited shipping. Like with Pakistan, we have a limited treaty. They cover only 3-4 categories of income. And then there is a tax information exchange agreements. They don't cover any taxation, everything. They just say that we will exchange information. Okay, so.
But this 286 that reporting, that has got something called ownership information that is to be provided by the parent company to the.
Oh yeah, so the ultimate parent company in CBCR, you report all the companies you have, which country they are residents, how many people they have, what is the revenue, what is the related party revenue. So the Indian company will not have that information also. It has to be at the ultimate parent company level only.
Only that level.
Yeah.
No, I am trying to understand from what you have started with, having so many this thing. For a person in India to know which is the real parenting company itself is not known.
Yeah.
That itself is slightly difficult. Because if you like to go beyond a particular point, you will get a dark because you will not know where it is traceable back.
True.
See, I may go from here to Maldives. Say, okay, from Maldives it may go to Germany. Germany, we do not know where it goes.
Yeah. So the thing is, what they're not framed separate taxation laws or say. They have said wherever the consolidation happens, this country will be the ultimate parent company and you will have to file it. So, assuming the consolidation happens at 3 levels. Okay, you have a group, take a case of a group which is Hindustan Unilever, take a case of Unilever. So, Hindustan Unilever is an Indian company. It has its own subsidiaries, it has overseas operations also. So, consolidation happens at one level, at India level also.
Yeah.
Okay. There could be also consolidation at UK level where Unilever is there. So there are some other groups, because Unilever is also listed, which are having 2-3 levels of consolidation. So they are saying, don't worry, one company at the top also fine, it's fine.
No, but for the Indian company to report, see there are 3 questions asked in that. We don't know. See what our income tax will expect us to answer. Yeah. Ultimately what boils down, name of the parent, name of the alternate reporting entity, if applicable. So it is very difficult to say which is the alternative.
No, so the group has to appoint.
Oh, the group, it has to come from the group.
It has to appoint the group. The group has to tell that I am not filing, I am the ultimate parent company, I am not filing for whatever reason.
Yeah.
For my behalf, this other company will file. Okay. So take an example, we were advising a client, the parent company was in Kuwait. Kuwait did not have any transfer pricing, they did not have this law. Now if they don't file in Kuwait, they will have to file in each of those countries.
Oh.
They had a subsidiary in India, they had a subsidiary in Indonesia, they had a subsidiary in Singapore, they had in 3-4 countries. So they said that let us file in India. But then they said India again it may become an issue, so then finally they decided to file it in Singapore. Okay, so the ultimate parent company may not file it also because there is no law there. Even if the company wants to file there is no law in that country. But I have to follow other countries' laws wherever I am operating.
So this is a question of uncertainty will hang over for some time.
No, it is clear. I think the guidance is very clear. So that's why I said that the CBCR report itself is 100 pages and after that 3-4 guidance on CBCR. So it basically is very detailed guidance. So unlike the Act which may have just only one section of 2-3 pages, there's a lot of guidance and we can rely on that guidance too.
What about 92D, the master file? Suppose I have only one subsidiary company in India and transfer pricing is applicable, it is being filed. Then they have to file 92D report also.
If the consolidated turnover of the group is more than 500 crores?
No, I am assuming if it is more than 5,500, what should I do? And additionally, apart from the 3CP, one more report has to be filed.
Yes, you have to file.
It is 500 crores or 5,000 crores?
500 crores consolidated turnover and 50 crores international transaction value of that company. But one company in India filed, that's sufficient. If there are more than one company in India. So POEM as a criteria for determining residency of a company. So this is also all coming from there. Little more guidance is there on the GAR provisions. So GAR provisions has also been referred in the OECD this thing where they said that GAR can also be introduced there. Previously they were against it. They said you cannot unilaterally do it, but they said If someone is avoiding tax, you can apply. Limitation of interest deduction. This is a direct thing that is coming from Action Plan 4. So business connection definition has been expanded. This is again coming from Action Plan 7, where avoidance of PE. Safe harbor rules. So again, so the thing is, this whole revamp that happened of the TP guidelines or this treaties, so it is not just to create transparency or help the tax officers, it is also to create certainty. Okay, it is also to help businesses. It is not just one-sided, because though only the governments were part of it, lot of recommendations, representations have come from NGOs, individual organizations. So it is, they have taken everything and then really introduced it. It's not just that the governments are preparing it. So significant economic presence has come. The definition in the Act, it is not permanent establishment, but in the treaty it is the permanent establishment. Safe harbor rules for low value adding services. So that for low value adding services, there's no point in fighting too much. Just give a cost plus 5% markup. So it has come in the safe harbor rules. Levy of buyback tax on avoidance of DDT. So this was again a treaty abuse mechanism, but it's introduced for everyone, but it is again to stop that treaty abuse that was happening through Mauritius and Singapore. So in addition to this, India has also revised its treaty based on the MLI principles or the OECD recommendations with treaties with Mauritius, Cyprus and Singapore. So these were the treaties where a lot of treaty shopping was happening, and it's obviously signed the MLI also.
The secondary adjustment also flow from this, or it's separately?
Secondary adjustment, not really. So it is related. It is very much related because there is one action plan, 14, which is improving dispute resolution. Okay, so there they said that government should interact more cohesively or more frequently to resolve cross-border disputes. So there the recommendation is, in treaties there is Article 9, which is associated enterprises. There is a sub-article para 2, which says that if one country does an adjustment to the profits of an enterprise for a transaction with other enterprise, the other country should do a corresponding adjustment. Okay, so when the other country has to do a corresponding adjustment, it has to ensure that the payment happens. Otherwise, your books and your tax returns could be at different places. So to ensure that also happens and it is just not one-sided, the secondary adjustment has been introduced. Because you will see that amendment in the MLI, which amends the treaty, they have said that 9.2 they have made it mandatory for all treaties. So digital economy, and feel free to interrupt because I'll be rushing a bit, but feel free to interrupt. We have too many things to cover. As I said, there's so much we can't cover everything in 3 hours, but I want you all to be with me so that we don't get lost. So everyone is aware what the digital economy is there. The material, they have done a lot of case studies on what is digital economy, what is network issues, what is data, all those things. But in substance, just take the example of Uber, and so you can do business wherever you want. The important thing about digital economy is the scale you can work, and the scale you can build up and work. So which is the company has the largest number of hotel rooms with it for booking? Can someone guess? Can someone guess which is the company which has a? So it's Oyo is an Indian. Yeah, India. It could be one of the largest, but the largest in the world is Airbnb. So it has on its website listed some 1.1 million rooms. And you will be surprised, it started operation in 2012. And very interesting story behind it. One person went to Stanford, or I'm not sure, Stanford, near Boston. There's some university. He'd gone there, and that time for some business visit, and that time they were at that university. This convocation programs were everything. So all hotels were full. He didn't find a hotel to stay at all. So, and the rates were also at the top. So one of his known friend or something, why don't you stay at my place? He said, no, how will I stay at your place? He said, you can stay and you can pay me. You can pay me whatever is there. And so when he went there, he stayed there. He have an extra room, you can pay me. And the morning the breakfast was also there. So that's why he named Airbnb, bed and breakfast. And then he got this idea, why don't I start a website where everyone. So within 4 or 5 years, it could become the largest hotel chain kind of in the world. The second one, which is, the one is the Starwood Hotel Groups or whatever is there. It has some 6 lakhs rooms. It's operating for the last 100 years. So it took 100 years for them to reach 6 lakhs, and this in 4 or 5 years, it has surpassed them. So the whole digital economy cannot be ring fenced also. It's kind of merged with you can do every business, whatever you're doing, with digital technologies and at much faster, larger scale, including CA services or anything. I mean, it's not come, but you never know, something may come up. So a lot of business have got disrupted, car rental agencies have got disrupted, hotels have got disrupted. So a lot of business have got disrupted. So I think slowly the services will also get disrupted because of technology. So action plan 1, that was on the digital economy. That's where the equalization levy came, because they suggested, recommended as interim measures countries can introduce equalization levy. Action plan 2 is hybrid mismatches. So hybrid mismatch is because of the different treatment for the same transaction 2 different countries take. So one maybe example where I have looked at it. So when a foreign company from Netherlands invests in India in convertible debentures, okay, compulsorily convertible debentures, when they invest in Indian company, the payment which the Indian company makes to the Netherlands company, what is it? Interest. So it is a deductible item. Okay. In Netherlands, they don't treat it as interest, they treat it as dividend, and they exempt dividend. The reason is they're saying it's compulsorily convertible, so it is a quasi-equity kind of a investment. So same transaction is being treated differently in 2 countries. So because of that, hybrid mismatches happen. So they could happen because of this. They could also happen branch mismatch structures. How the branches are treated by the head office country and the branch country. Because of also that, they could happen. So there was this Bank of Nova Scotia case of I think the Calcutta Tribunal or something. I don't know what's the status of now, but that is an example of an Indian example, where an Indian bank branch was paying interest to his head office. They didn't do a withholding tax. Went to the tribunal and they won at the tribunal. So they said, when a branch is paying to the head office, it is paying to the self. There cannot be a withholding tax on payments to the self under the Indian law or something. But in the profit attribution, it is being considered as an interest and you're claiming a deduction. But when you're paying it, it's not being considered as an interest. So that is a branch mismatch. So 2 scenarios it could happen. One is a transaction being considered differently, or how the branch is being treated. The branch mismatch, India is not impacted that much because India has on its own always lot of exchange control regulations and other things. So not too many foreign companies operate in India through a branch model. So, but in the Europe and the developed countries, it is quite common to operate through branches. So that action plan 2 takes care of it. So this again is a domestic change, and some of the MLI also has it. But again, we will be focusing on what is relevant for India. Some of these things may not be relevant for India. Control foreign corporation companies rules, again, this is to stop companies from shifting or accumulating profits in their overseas subsidiaries. So India, we have the POEM, which is somewhere little related, but this is little different. Control foreign companies is you have companies overseas which are not doing any active business but just doing passive business and accumulating profits. So that gets taxed in the parent country's jurisdiction as they earn, not when it is repatriated. So they are given how do a countries can build up CFC rules. They are given recommendations. They said 6 blocks, what definition should be there and all those things. India, obviously in the DTC, India proposed to introduce CFC, but currently we don't have CFC.
You are talking about companies which are having license office only here and trying to do business.
No, so
promoting business in India for the foreign company.
No, so that could be a branch mismatch kind of a situation where India is treating it as a liaison office, the other country may be not be there.
Here they don't do any business at all. It's only a license office, registered with the RBI, everything. Of course, now they have changed it to a business model.
Yeah.
But earlier it was existing Japanese companies or these people were there.
Yeah.
That's why I'm asking, because as you rightly said, the business will be done and the parent company will only earn.
Yeah.
See, it's like a third party where they come and do identify the sources and let them know so that they will do the business directly.
Correct.
Of course, it is the same company, not a different company.
So that is a branch mismatch structure could happen there also. What could happen is, in the same thing which you said of Japanese having a branch in India or liaison office in India, and you don't pay any taxes of the liaison office because Indian law doesn't tax it. Yeah, so correct. But in Japan, what could happen is you may treat this as a branch, and it could quite possible Japan has a territorial system of taxation. Basically, it will not tax overseas income because it will see overseas income earned will anyway get taxed overseas. So why do you have to tax again? So it could follow that, and then again, non-taxation is happening. The Indian company in India is not paying taxes, or Indian branch or liaison office is not paying taxes, taking advantage of India rules. There they are saying that the sales are being the business is primarily done there from that thing and it's being earned there, so I'm not paying taxes. So that could be a branch mismatch structure. Control foreign companies are different. What it basically means is the ultimate parent company has to pay tax on the global profits, whether it receives or not. And you give a credit for what all taxes the other countries have paid, but you pay the taxes when the time it's earned itself. So this is primarily to target passive income, not active income. So if some companies are having having just shell kind of a companies, so those companies get taxed at the parent level. So in US it is quite common, but in US it is another extreme. So US have this check the box rules, where you have the option whether you want to check the box or not. So then you will check the box for ones which you feel is beneficial to you, and you will not check the box for the ones which are not beneficial to you. Limitation of interest deductions. This already in the Indian Act it has come, section 94B, which says that you will not get more than 30% of your EBITDA as interest deduction if it is from a related party loan. So you can't do you can't base erode or you can't do too much leveraging. So there was this one case of a Belgium branch in India, which was, they put some 1 lakh rupees as branch capital, and then they had some 248 times of that as loan given. So it went to the tribunal, the TPO said that this payment is way above what companies would normally pay, and then I disallow the interest. I will allow you just 2 times of your equity as your loan, rest all I will treat it as equity, something like that he did. But in the tribunal, the company banned because they said there is no thin cap rules in India. Thin capitalization rules are specific rules that it says how much equity and how much debt you can keep in a company from related party. So in India, for overseas investments, Indian investments, where you have this restriction, you can have debt at 4 times under the exchange control. It is not under the Income Tax Act. You can have only 4 times your equity investment as debt, which you can get. So, but that is also up to I think 5 million worth of loans only. Above that there is again.
Even that is applicable also for manufacturing units, not for
Yeah.
service.
So.
For also for the interest rate, they cap how much.
Interest rate also there is a cap. So there's in this report, if you read Action Plan 4, they said there's a lot of companies worldwide are stripping the companies of the profit through interest deductions. Now they said that we can introduce thin cap, but they again saw that thin cap will not solve the problem, and the thin cap is more complex, because what they also wanted is certainty. Okay, then they came up with this simple solution. They said 10% to 30% of your EBITDA, only interest deductions will be allowed if it's from a related party loan. And they gave a choice, because each country has its own interest rates and everything. So they said between 10 to 30 you can choose. India choose 30 because in India the rates of interest are higher. So there is also a recommendation of a fixed ratio which is 10 to 30 and a group ratio. So group itself as a whole may be more leveraged, so you can go up to the group ratio, but India did not introduce the group ratio. They said the Indian company 30% you can pay if it's for. So I'm not going into the other action plans because we'll go on and on then. We are already almost an hour into this thing. What are the other action plans? But at least we should know what are the other action plans. So Action Plan 5 is on countering harmful tax practices more effectively, taking into account transparency and substance. So an important thing here, as I said, started with, none of the companies are really doing anything illegal. They're not doing anything illegal, right? They are taking advantage of the tax laws. And some countries are, which are the tax havens, are saying that we will give you these advantages. It is not that they are trying to play around or something. They are saying, come, let's have an agreement. You tell how much tax you will pay, let us negotiate. That kind of environment has happened because this is called race to the bottom. So there is a competition between countries also to get investments and other things. So they said, how do we counter? These are harmful tax practices. So how do we counter this? So there are two ways they have suggested this could be countered. Because they also said that to levy tax or not is a right of that country. OECD or G20 cannot go and say to Mauritius that you start levying tax on capital gains. India cannot go and say that. It is that country's sovereign right whether to levy tax, in what form to levy, how to levy. So they said, but you give your benefits, but give it based on certain criteria, which they have introduced here is what they call the nexus criteria, substance. So they said you give it based on what activities are happening in your country. And they said, how do I find what is the nexus? How do I find? Then they said they have found a way that cost incurred for that activity in that country could be a basis of getting the nexus. So if you look at it, India introduced the patent box scheme. How many of you know that? Patent box scheme in 2015 Finance Act 115 BBF section, which basically says that if you're earning income from patents, that is you're earning royalty income, I will tax you at only 10%. Gross basis of taxation 10%. That's what the Indian patent box scheme says. But very important to note, the Indian patent box scheme has borrowed the language from this action plan. It says it depends on nexus of what activities gets carried on in India. So it is not that I will just register the patent here and I will give you the benefit. So it depends on, you have to actually carry on the activity here to get the benefit. So in effect, if someone is opting for the patent box schemes, he will not pay any taxes in India, because the tax rate is 10% gross. Now, when royalty income you earn from other countries, there is a withholding tax in that countries. And India has a very wide range of treaties, 93 countries. It has comprehensive tax treaties. So you get a lower rate. Okay, you get 10%, 15%. Otherwise, in some countries like US, the rate on withholding tax rate is 30%. So So you get a lower rate. So you can take the benefit of that lower rate also. So even after that lower rate, there will be 10-15%. So after paying the 10-15%, India you will not pay anything because you will take credit for that 10-15%. So that's the nexus concept that has come from this action plan. And the second thing what is there is to compulsorily exchange rulings. So that is again a mandatory requirement. And for that also the companies have actually signed one more agreement which we are not covering right now. It's a multilateral comprehensive agreement, MCCAT something is there, where they have to exchange information, not just this information, the CBCR information also. Okay, so that both two are coming from this action plan. Action plan 6, this I will not touch upon here, because this is action plan 6 is so this whole thing changes what they have suggested, everything. As I said, certain changes are domestic law. The country wants, they will do, they don't want, they will not do. Certain things are to the treaty law. Now, out of these things also, they said that not everyone would want to do everything, but some things everyone has to do. So this is a minimum standard. You don't have an option of saying that no, I will not agree to this treaty abuse. So this treaty abuse action plan 6 is a mandatory standard which everyone signing the MLI has to agree to it. And we have covered it in very detail in the subsequent slides, so we'll treat it there. So you know what is treaty abuse, right? Everyone knows what's treaty abuse? Maybe I can get eyes, maybe say yes, because I hope everyone is awake. So we will look at it later. Action plan 7 is preventing the artificial avoidance of PE status. A taxable presence, artificial avoidance. Why artificial avoidance? Is basically the treaties, as we said, had provided certain exceptions, certain conditions for a PE to get created. Now, I will, through agreements, through splitting of companies, through splitting of activities, I was avoiding that. So that's why artificial avoidance. In substance, you are actually doing business in that country, but you are trying to avoid by going by what is there in the treaty. So this again, India has amended to the MLI, tried to amend the treaties. So this again we'll look at it in very detail later, so I'm not covering it. Action 8 to 10, there were 3 things which together in one report they have given, because it was primarily transfer pricing. This has got incorporated already in the OECD guidelines. So basically they were on intangible transactions, high risk transactions, and risk and capital. So there were three areas where this action 8 to 9, 9, 10 got covered. The intention in substance is to tax profits where the economic activities are undertaken. So that's the intention.
There is a negative value creation.
Yeah, value creation, wherever the value is created. It's to tax profit wherever the value is created. So this is somewhere related to action plan 5, which says nexus. Somewhere related.
OECD has written to me that they don't have framework for negative value creation.
Negative value creation, okay.
They written to me that they don't have the expertise to work on the area.
Yeah, quite possible.
Any help later on if you can?
Yeah.
About the research network.
A very interesting negative value creation. So value creation is, so he has a very interesting concept. So maybe what I heard from you, I'll maybe speak about it. So what he's trying to say is that a lot of companies are coming doing business. Good enough, they are coming and doing business. So they are making profit, good enough. But they are also harming me or harming India. Okay, or harming Indians. So that is negative value creation. Instead of, so they may be harming. So when he says harming Indians, like food companies, okay, so a lot of processed food, Coca-Cola, Pepsi. So they are selling processed food, which is good to taste and everything, but it's very, very harmful. Okay, so a lot of processed food is obviously, we know now it's a lot of harmful. So these his point is whether these companies where they are actually harming India and then also making profits, can they be asked to pay for it. Because who will pay for it is ultimately, who will pay for it?
Government.
The government will pay under the Ayushman scheme maybe up to 5 lakhs. But I mean, that also not for everyone, for few of the deserving ones. But for us, we ourselves have to pay for it. So that's what she's saying, this negative value creation. How do you do? So maybe I think you will have to do more research on it. But that's a very interesting thing. So we'll move forward because as I said, 6 and 7 we will cover it in little detail later on. Action plan 11. So which is on measuring and monitoring BEPS. They said we are doing all those things, but is it effective? Or is it just theory? Or is just making noise? But is it really working? So they set up a committee and everything. They will monitor it also. It's not that we just want to make one-time change and then leave it. Let us keep relooking it, whether it's working, not working. They're coming up with peer review reports, how each country is implementing. And there are already results being shown. Because how are the results being shown? How do you know the results are being shown?
When
Improved tax collections.
taxes.
Improved tax collections.
Yeah, improved tax collections, yes, but improved tax collections, unless you segregate and say from which company it has come, how much, you will obviously not know. But you can also know.
Unification of structures.
Yeah, correct. So this is one thing. So companies are themselves unwinding their old structures. Take the example in India. Facebook used to bill from Ireland. Now they started billing from. Oh, how many advertise on Facebook? Anyone advertises on Facebook here? No one? Okay. So very easy to advertise on Facebook. You can start advertising from as less as 500 rupees or 1000 rupees. So you were earlier paying to Ireland. Now you are getting billed from Facebook India. So clearly change in the structure. LinkedIn. How many of you have paid version of LinkedIn? LinkedIn again was billing from overseas, Singapore or something. They have changed it. Now they are billing from India. So this has not happened before. I mean, this had happened very recent, in the last 1 year or so. So the structures are also changing. So you know it's working. Action plan 12 is disclosure of aggressive tax planning. Okay, here there is a very detailed study in this report on the UK. UK has this mandatory disclosure where companies doing any tax planning have to disclose that I am doing this tax planning.
But but will it work?
It's working in UK.
They
UK
have
is
to
a-
even provide whoever has given the opinion something they can call for the
Yeah. They can do
studies.
that. They can do
It's just
that. So
one.
and there it's not like our assessments that happen, because this again I have heard. It's not like surveys or searches that happen in our there. If they go for a search or a survey, it's not that they call you. They go. They will sit with the tax director. They will sit with the finance manager. They will understand how do you function. How do you do tax planning? Whom do you take advice? So that kind of discussions are there. It is not that show me this. So it starts with discussions. How do you do it? And then if they feel comfortable, they'll just go away. They don't get the comfort, then they'll try to get some more.
Volume is also not this huge, right?
Yeah. So they will not go after everyone. They will they will go selectively. So that's the action plan 12. That companies should put a system where. So did this have any impact in India? Did this have any impact in India? Can anyone say any example? Do you think this has something of this sort come in India? No one? In the recent tax audit report, something had come. Did someone attend the tax audit report seminar? Was there on Saturday? No. Okay. So in the recent tax audit report which got amended, they said the CS would certify also whether the company had entered into any impermissible avoidance agreement. Right? Then they amended it, then they removed it.
They
Just
postponed it to 1/4/2009.
Yeah. So CA was required to tell if the company has entered into any transaction which could be subject to GAR. So how will the CA really know? And even if he knows whether he wants to certify, disclose that. So this is something similar, that the taxpayer should pay what all tax planning they are doing. Because a lot of tax planning in India works on the principle that the tax officer will not be able to catch it. So that's the principle. That should not be the intention. It should be transparent, and then you should get it. Action Plan 14. So there are only two standards which are called the minimum standards or mandatory. Action Plan, one we already saw. Which one was it? 6. Action Plan 6 was on treaty abuse, stopping treaty abuse. The second is Action Plan 14, making dispute resolution mechanism more effective. So as I said, there's one principle which says, which was to help the tax officers and everything, but there's a balancing thing. The taxpayer should not also suffer. So if there is any dispute, it should get resolved quickly, because some of the companies don't really want to pay double taxation, but they may get double tax. They're not doing any tax planning also. It's not that all companies who are facing TP adjustments in India are actually doing some aggressive TP planning. They are doing just to balance both countries. So in the case of balancing both the countries, if they're not able to, they are being subject to other tax, higher tax or lower tax in one country, the other country should get that much benefit. So this is a mandatory action plan. Action Plan 15 is to develop a multilateral convention to implement a tax treaty related measures. So assuming this MLI was not there and you still wanted to implement whatever you have found the loopholes and close the loopholes, how many years would have it taken?
It may not happen, some cases it may not even happen.
Some cases it may not happen also, but I'll give you an example. The India-Mauritius tax treaty, the negotiation started in 2007. It got closed in 2016. So how many years?
9 years.
9 years for amending one article of a treaty. I'm not saying that every treaty amendment will take so much time, but there is so much effort that needs to be put to amend each treaty. So they said if we tell each country to amend the treaties accordingly, because the OECD has its own model convention. They have already amended that OECD model convention based on whatever loopholes they have found out and whatever recommendations they have. They have already amended that. That model convention, going forward, if someone is entering into treaty, will take that model convention and accordingly enter into treaty. But there are already 3,500 treaties already there in the past. How to amend those? So it will be. So they said we should have a multilateral instrument or multilateral convention. So it's used both ways. You can call it convention also or a MLI also. So that's the what the 15 action plan recommends, that we should develop it, and that the development, because this reports came in October 2015, and after that now the MLI has been signed in, or October 2014, MLI has been signed in July 2017. So when do we take a break? Feel free if you're feeling fatigued, we can take a break, or we can continue here. If you want to continue, we can continue.
You can continue.
We can continue? Okay, thanks.
Any specific, if you can do action plan 8 to 10, if there is any detailed discussion, we will be very happy.
So action plan 8 to 10 amends the transfer pricing guidelines for intangibles, high risk transactions, and risk and capital. So how do you value intangibles? So it's detailed guidelines. So if you have an intangible transaction actually,
Okay.
So I will not be touched on that aspect right now because that's a very specific thing which will not be applicable to everyone. So we'll finish up the MLI, maybe we can connect offline. So what is MLI? So it's just giving a background. I mean, I've said all of this, already said it, maybe I'm just pausing here for a minute. So this is one agreement which they said we can amend all the treaties at one go. But is it so simple? Is it so simple? All treaties are different languages, everything is there. So it's not so simple, and that's what you look at it when you look at the MLI language also, it's very confusing at first read. So the concept is that we will amend treaties. So we have created one MLI with standard language, everything. Now whoever signs it, so suppose India signs it, and India has 93 treaties, and all those 92 countries also sign it, then India and those 92 treaties gets amended at one go. That's the thing. So that's a ideal scenario, but it's not so easy because each treaty is different, language is different. So how do you amend? You can't put so many languages, and not countries would want. So the MLI also gives certain flexibility. So currently, if you see, 83 countries have signed MLI, including India. Now, out of these 83 countries, so it is, when I sign the MLI, I will have to also say which countries I want to change the report with. So India said I want to change reports with everyone, treaties with everyone. So 93 all. Mauritius has 40 treaties. It said no, I want to change with only 24. So like that, 2,400 treaties were matched. Or 2,400 treaties were listed. Out of those 2,400, 1,200 plus treaties were matched. In the sense that those treaties may get amended. So if you see what's the objective is that not all treaties will get amended, only 50% will get amended. Now out of this 50% also, all those 50% will not get amended for all the things what the MLI says. Out of those also they can further select which articles they want to amend. There are 2 articles which are mandatory, don't have an option. Those will get amended for sure. Others, you have a choice, whether you want or not. So now MLI, once it is there, so previously if you were to advise to a client for a cross-border transaction, what you used to do? You used to see the act, whether some special provision is there in the act or not for that transaction, and accordingly advise. Then you used to also see the treaty, okay, whether which treaty, whether is eligible to treaty benefits or not. So you used to see basically 2 documents, right? So what will happen going forward if you have to give an advice to a client now for a cross-border transaction? What all you will have to see? Yeah, you will, because MLI also is now parallel to treaties. So you will have to now also start seeing the MLI. Now whether you have to start seeing for all transactions or not, we will see which ones get amended, and for those at least you will have to start seeing. Now, yeah, so this, you have to see 4 documents. You have to see 4 documents, not 2. One is the treaty, obviously you will have to see existing treaty. You will have to see the MLI, obviously. The second thing is, when each country signs the MLI, it will give a list. These is my positions on the MLI for the respective countries. That list you will have to see. Then you will also have to see, because when you are advising on a cross-border, right? You are advising from other country resident or other country. So his country's MLI positions also. So you have to, for advising, you will have to see 4 documents now. Quite complicated, right? So in the next slides we will also look at it. So you will have to actually see the 4 documents to better clarity, but in the next slides I have listed, there is also a matching tool. So it is very difficult for you to basically go so there is a matching tool which is there on the OECD website itself. You can go there, you can select and you can download it also, but it gets updated as and when companies sign and give the agreements and all those things. You can select India and you can select the respective country and it will show what all got amended at one place. So MLI, how it comes into force is once you have signed the MLI, it's entered into force. So India has said on July 2017, 67 countries signed it. So it entered into force. Now it has to enter into effect also. Enter into effect will happen when the respective countries do their domestic procedures and then give it. So India has not done its domestic procedures yet to give it back. Say that fine, we have done it. So each country has to do that. Already some 10-12 countries have done the domestic procedures and also given. And what the MLI also said is that it will come into effect from the end of the 4th month where 5 countries already deposit their final MLI positions. So in February, I think Slovenia was the 5th country which got deposited it. So from 1st July 2018, it is already effective for whatever countries have where the matching is possible. So for applying the MLI, you will have to follow 5 steps. First steps, entry into force of the MLI. Whether the respective country has signed the MLI or not, you will have to see. Second thing is you have to find out whether it's a covered tax agreement or not. I'll use one example consistently across this presentation so that it's easy. Which country is someone's favorite? Which country?
BVI.
BVI, India doesn't have a treaty.
Singapore.
Singapore, okay. So we'll take, what's your name?
Sunita.
Sunita. So Sunita is in Singapore. I am taking the Indian part. So entry into force of MLI, India has signed the MLI, so it has entered into force. Singapore has also signed. So MLI has entered into force for transactions between India and Singapore. Covered tax agreement, India has covered all its agreements. They said I want to amend all the 93. But as Singapore also said, India, does it want to cover under the MLI or not, has to be seen. We'll assume that Singapore has also said that fine, we want to cover India. So the second step is also seen, okay fine, this has become a covered tax agreement. The third step, now we go to specific clauses. For those clauses, India has applied, not applied, that country has applied, not applied. So what are the clauses which gets amended, we'll look at it. Then notification of existing provisions. So this is again a step. So what happens in an MLI is something which you're getting new. This is not there in the treaties, you're getting new. So that will come in the absence of. It's not there, it's coming in the absence of. Something which is already there, I am amending that. So when I say this, like P definition is already there in all my treaties, right? Now I want to amend those things. So I have to give the clause which is there in my existing treaty which I want to amend. So 5 paragraph 3, this is already there, I want to amend this from the MLI. So I should notify. So that is the notification of existing provisions which I want to amend. Singapore also has to notify, I also want to amend 5.3. So then I can apply the MLI. And then too.
That both of them should match, is it? Like
Yeah, both of them should match. The same article. So if the choice is given that you can have for a P definition option A, option B, option C. I want option A. You say I will take option B. It doesn't get amended. I and Singapore has to take the same option for the MLI to amend my tax treaty. And you will see the MLI currently, if I look at it, it's a little difficult to understand and interpret and read and everything, because it's too much cross-referencing and all those things. But once this gets finalized, I will redraft my treaty itself. Then it will become easier for me to read. What I will do is, and someone will publish it, or countries will publish it. What they will do is they will remove the old Article 5.3 and put the new article. So it becomes very easy. But as of today, if I have to read an advice, it's a little complicated. And my objective is at the end of the day, end of the class or this session, when you all should go, at least you should be able to read the MLI in the form it is there as of now and may be able to advise.
But ultimately the treaty will hold good as of date. Probably MLI is going to make the changes, may change or may not change.
Yeah, may change or may not change. So if you look at it, the 2,400 treaties are listed. So that data which I've taken it from the OECD website, because there is a tool there which is giving that those numbers. Out of 2,400, only 1,200 are matching.
No, my doubt is, suppose you are giving to a specific example, like you said, between India and Singapore, then you need to keep your fingers crossed as to what is going to be the change in the current treaty after the MLI is being assigned by both the countries.
Okay, so what has happened is, so if you see 83 countries have signed. Okay, so up to the stage of step 4, it has happened. So what will change everything you will know. From when it will enter into effect, that is pending. So if you have to advise a client, suppose is going to undertake a transaction and is saying that I want to do this business in India, I'm coming from Singapore, how do I structure it? So you know what is going to change. That change may come 3 months down the line, 6 months down the line, it's going to come the change. It's not that you will advise that because till now MLI is not effective, let us do what you have done. You will not advise that way because you are advising for the future, right? So you will say that this is going to change. So whether you want to do this way or some other way, you'll have to see.
No, exactly. This is what I was trying to capture. See, there should be an abundant caution of what is the impact of the change.
Yes.
That's all.
Yes.
So once it is coming into effect, whether from that date onwards it will be effective for a particular year, whether this MLI will be applicable or the bilateral agreement would be applicable.
See, MLI currently it is parallel to the treaties. Okay. Now this is effective. Treaty is effective. MLI is not effective. What MLI is going to change, that is clear now. For this treaty, for India-Singapore treaty, what MLI is going to change is clear. So currently only treaty is effective, but this is going to become effective very soon. So you know what is going to change.
That
now,
will be prospective only.
Prospect. No. So very important thing.
In that current year, for that year, whether a portion we have to calculate that way and portion we have to calculate this way?
No, that's not
How
it.
it will be?
Yeah, so it will, once it become effective, it will be as if it was from the day one.
Always
there.
that.
Yeah, that way. So just to give an example, now the India GAR rules or the India-Mauritius treaty which got amended, that has a grandfathering rule. Even the India GAR also has a grandfathering rule, right? It's something you have done in the past. In that old rules will say will not make it retrospective, but it is not like this in the MLI. So, if you do a transaction today, which today MLI is not effective between India and Singapore, and India has to pay some $1 million for some services which I have taken from Singapore. Today it is not effective. I have entered into the transaction and withholding tax is not applicable or something. 3 months down the MLI becomes effective, and then I have to make the payment. Then I have to do the withholding tax. It will not say because you have entered this transaction before the MLI was effective or before, that is not there. So no grandfathering is there. So treaty abuse, if you are doing something and you are caught in the treaty abuse, you will not get the treaty benefit. You cannot say no, this transaction was entered some 30 years back down, so I should not be caught in this new MLI. That's not there. So you are abusing the treaty, you will get caught.
So another question is, now India is going to enter into a new agreement with a new country. That is the 94th country. That also agreed for MLI, and India is agreed. Then there will not be any bilateral agreement. They will go directly with the MLI.
No, sir. So very important. As I said, once this India also makes this last steps completes, India will redraft its treaties, because now, as I said, I have to look how many documents. I have to look 4 documents for advising on one thing. Why do I have to look at it? So countries will redraft the treaties. They will say, now my treaty looks like this. Or even if the countries doesn't redraft, I myself as a consultant will redraft, or someone will redraft and say the treaty, like you will put the current provision, and you will in the act you will put in the footnote, earlier this was like this, right? So you will redraft it, and you will have to look at it only one document, treaty, okay? And MLI is not comprehensive. It is not amending everything. It is amending only few things. You will see only 5 parts are there, and out of those 5, only 3 are applicable to India. 2 India is not even touching. India is saying we are not bothered about those because those are not impacting me as of now. But it's a dynamic document, in the sense like India has notified 93 countries. India has entered into one more bilateral APA. Now, assuming India is entering into a fresh bilateral, it can consider all these things and consider those in the fresh bilateral itself. Okay, make the changes in the new bilateral treaty.
For the new RDTA treaty, MLI does not substitute for the treaty. Treaty has to be there.
Treaty has to be there. MLI meant only few things. So I will just come to it. This is again saying the same thing what we said, how you will really apply MLI. Again, maybe I've just, the same thing has come twice in a different way. Yes, no, a flowchart kind of form. Have you looked at it? You can look at it for a moment, half minute, and then I'll move it. Okay, is it fine?
Yeah.
Okay, now before we go, we saw certain abbreviations. Now there are certain terms which MLI is using, which we have never heard earlier, because the terms were nowhere there. So maybe it's important to also refer to those terms and definitions which is there in the MLI. So these are the terms which you will not find anywhere else. So they are not used contracting country, because that's or contracting state, which is used under the treaties. They have used contracting jurisdiction. Why they have used contracting jurisdiction? Because they want to be broad-based, because anyone can want to sign it. Like Hong Kong, it's not a country, but it has its own rights as far as even the foreign policy is concerned and treaties are concerned. So they want to broad-base it, so use contracting. Compatibility clause. So this is which defines the relationship between the MLI and the treaty. Matching exercise, MLI position, notification clause.
I think the contracting jurisdiction like Hong Kong, Taipei, ROC also will come in there.
Yeah, they could be. So that's why they have kept it broad-based. They didn't want. We'll move ahead. If you had a look at it. Many more, some more. Reservation clause, signatory, substantive provisions, template. Anything you want, you're not getting clarity, you can just tell me. You're not able to read because it's a little far off. So if you're not able to read or something, you want clarity, just let me know. So as I said, we have to look at 4 documents. One is the treaty. This is the other document. This is actually the MLI, which has, the next slide we have the structure of the MLI. And this is the list which I said MLI position of. This is I've taken the print of India. So you will have for each of the countries, 83 countries, they will have would have given like this document, which lists their reservations and notifications. Now, what does reservation mean? Is basically I don't want to apply this article of the treaty. Notification means this, I'm notifying that this clause is already there, similar clause is already there in my treaty. So either I want to amend it or I say no, this is there, so I don't want to change anything further. That also you have to notify. Reservation means I don't want to apply. Now what could also happen is, I am giving this India list. India has given this list, and for one of the articles, assuming treaty abuse or P. So India said this P similar provision is also there in my treaty. It is under Article 5.3. I want to amend that. Now Singapore also should give the similar thing. Okay. Now if Singapore says 5.4, there is a mismatch. When I am notifying itself, there is a mismatch. So that is the notification mismatch. So that if there is something mismatch, the OECD will...
Essentially the countries, even before giving this, they have to bilaterally talk to each other and see how...
Not necessary.
Not necessary.
Not necessary.
But otherwise it is going to be a very long process, isn't it?
No, it's not a long process. So there is an OECD depository who is maintaining all these things. So they will see, oh, India has given 5.3, but that country is given 5.4, so they will just call up which is correct. Just tell me quickly. And then...
That's what they will be taking up.
Yeah.
Some kind of a moderator.
Yeah. Shall we go ahead? So this is the structure of the MLI. 7 parts, 39 articles. Now, as I said, we will focus on what is relevant for India. Because what is not relevant for India, it will be too much at one go. So let us just stick to what is relevant for India right now. So we will go article by article. I think we should be able to finish off within an hour. Is that fine? Sure. Yeah. So just in case, what I have read, I have also put it here. What is there all on the OECD website? So even if you want to read it independently, and so there is signatory and parties. These all documents are there. So which is there, which is given. Information brochure. I think you all got a print of the information brochure. This is also from the OECD. Frequently asked questions. Text of MLI, which I just showed you. Explanatory statement. There is a, like the OECD model convention commentary. There is an explanatory statement also, which again each article, what it means and all those explaining. Then a legal note on functioning of the MLI under public international law. This is also given but not so relevant. Then there is this MLI application toolkit and database, which is kind of a tool, or you can download it and use it as an Excel file also, which is MLI matching database, matrix of options and reservations, flowchart. There is a flowchart also, which again is very complicated. Complicated in the sense that it is trying to look at everything, but as I said, not everything. India is not looking at everything. India is looking at very few things only. So step-by-step overview. So this all is there under the OECD website itself, all freely available. So this is again when the MLI will apply. So this is actually in the final article, but I've just put it in the start itself. So it will apply 2 different dates of application. One is with respect to withholding taxes. Okay, now they are not. This MLI doesn't give any withholding tax rates or anything. Okay, so you would be wondering why withholding taxes. So now going forward, because MLI restricts treaty abuse, you will have to see whether that party is eligible for the treaty benefits or not. Okay, because if it's eligible for treaty benefits, then wherever you have to do withholding, you will give the treaty benefit or not. So from that scenario, it is withholding tax. The MLI doesn't give any treaty rates, It doesn't say you apply this rate for this kind of a payment or tax at this rate. That's nothing concerned. So that's from that perspective it is there. It comes into place. So both the countries have to finish the domestic procedure, and it comes into place from the next calendar year. So suppose India and Singapore finish it by November, it should come effective from 1st January 2019. But India, again, as I said, there's some flexibility given. They said you can opt for your country's tax year also. So we look at it, what all flexibilities are there given everything for each article. So India has opted, India has taken a position that we will apply it from the next taxable period following 30 days of the receipt by the depository of the latest notification by each country. So India is saying basically I will apply from the Indian tax year. So if as long as next following 30 days. So basically if India and Singapore finish off the process by February 2019, then it can start applying from 1st April 2019. But if you finish it by March 2019, then it will start applying because 30 days they want after, and after that next taxable period. For other taxes, okay, for normal PE taxation and other things, for other taxes, they have taken the 6 calendar months. After 6 calendar months, it's nothing related to the year. But India again says 30 days from 6 calendar. So India basically saying that, okay, India is again here restricting to the, okay, both are saying taxable period, both are not saying financial year, both are saying taxable period. So India is basically taking 30 days more. They are saying 6 months from the end of the month. India is saying 30 days, 6 months from the, 30 days from the date of receipt of the final notification.
But for withholding,
So basically you should finish off everything by August for it to apply. So in effect, what are we saying? It's not going to apply from 1st April 2019 because India has not yet finished. It will apply only from 1st April 2020.
but as you referred earlier, the financial year for Singapore is calendar and India is April, March. Then it will apply differently in the
Yeah,
case.
that's it. That's there in the current treaty also.
Treaty
We have
Notification,
for
ratification
different
could be
taxes.
different. Different times it could get applied. That's it. So first 1 and 2 articles were general, what is their MLI, and very briefly of the definitions. The third article is on hybrid mismatches. Now this we don't have to worry because India said, India has given its reservation. So if you look at it, Article 3. So I mean just showing you what is there. First, India has in under Article 2 given the list of 93 treaties where it want to apply. And it is not even given the treaty name, it is also given what was amending instruments date, protocol, everything is given. Then we go Article 3, which is there, where India has reservation. So India says, India reserves the right for the entirety of Article 3 not to apply to its covered tax agreements. So we don't have to worry. But this basically tries to plug the loopholes on the hybrid mismatch structures, which as I said, India is not that impacted, but in some times India also gets impacted, but not that much impacted. So we don't have to. So here again, as I said, the same transaction could get considered differently, or there could be a branch mismatch. One thing I also missed is also fiscally transparent entities which take advantage of this provision, because of the hybrid mismatch. So just to give an example, there is a partnership firm, which this quite common happens in the European Union. There is a partnership firm, maybe in France. Now France does not tax partnership firms. It taxes the partners. Now in that France partnership firm, all the partners would not be residents of France. They would be residents of some other country. So they would be residents of some other country. In France, nothing gets taxed because it doesn't tax the partnership firm. The partners who are getting are residents of some other countries. And they could be residents in some countries where the taxation rate is low, or also could be they may not be taxing it, saying that this is earned somewhere else for them, so that's why I'm not taxing.
US also has something similar, right?
Yeah, so US has this S corporation, which is kind of a partnership firm, which is fiscally transparent. It will not tax the S corp, it will tax the respective partners. So India will tax the partnership firm itself, whereas partners get it, it's exempt in their hands. So this we don't have to, because in India, again, India never thought this is an issue. Only the India-US and the India-UK treaty have something which is relevant to this. India-UK treaty, that also got amended very recently, because after the Clifford Chance tribunal ruling or a High Court ruling, where Clifford Chance was a UK-based law firm which got some revenue from India, and then they were not given the treaty benefit because India said that the definition of residence means a taxable unit or a taxable person. So this in UK it is not a taxable person at all. So that's why I will not give you the treaty benefit. So now the India-UK treaty is amended to include one briefly line saying that the benefit should be available to the extent the resident of that country, that income is taxable for the partnership firm. So if the partners are resident in UK and Netherlands, to the extent the UK resident partner gets taxed in that country, to that extent I will give the treaty benefit to that. So it's not relevant, I'm not, we'll move ahead, but if there is any question we can take it up, others we can move ahead. As I said, not much impacted, very few cases where India really gets impacted. Now in same thing, Article 4, which is on dual resident entities. What is dual resident entities? Is it possible? Yes, so there is a tiebreaker rule for finding out the residency of individuals, very detailed. For companies, that is not so detailed. It says wherever the effective management of the country is there, I will take. Now, quite possible that the two countries say that these residents of my country. So they could be a dual resident company also. So now what it specifically says, so even without this amendment, it could be quite possible that someone could go under the map if someone is getting impacted by this and say that both of you are telling I am resident, so I could have got it under, but now it's specific thing has come in. So it says that the component, if someone is dual resident, the component authorities have to decide which residence is it. It should not be that person has to go or something. If something is considered as dual resident, the two companies, competent authorities, sit and decide which country it is resident. And if you are not able to decide, then treaty benefit will not be given. So India did not give any reservations, so this will apply. And here there is not many options. Like some of the articles you will see, they will give given options. You have option A, option B, option C. Here there is no option. They just said it's a very simple thing that if someone is a dual resident, then the competent authorities have to decide, and if they are not able to decide, then don't give them treaty benefit. Now, India also already has in Article 4.4 of its treaties how to find residencies. So that will get amended now. Okay, so currently it says wherever the place of effective management is there, or from the domestic law, something like that it says. So India has notified all these articles where something is there. Now this will get amended with this. So all the 93 treaties of India has something to cover this aspect. You want to take a break or it's fine?
It's fine.
It's fine? Not tired? So this will all get amended. It's again a very simple, it's not not too frequently it is not used. It's a very common thing, and it's not very common, it's very uncommon. I've just put the article itself here. So just to give an overview, each article has sub-paragraphs. Now this sub-paragraphs, the first one is what is the substantive provision, or what is the article that's going to go in the treaty. 1, 2 or 3 in some cases. After that you have the reservation clause. Then you also have the notification clause. And then you have the compatibility clause. So every article, that is the flow. So in this, there is substantial provision is only one paragraph. Yeah. So I've just put the paragraph. Now I've just put it so that you could read it, how it reads, and maybe if you are able to make context out of what I've said, take the example of India and Singapore and just see. So the first time I read it's a little complicated, because you see the first sentence, it goes something like six lines, one sentence. So it is not so easy or so simple to read, it is a little complicated. So this is the one article which will get replaced in Article 4.3 of all of India's treaties. Now Article 4.3, if you read, it is just 2 lines. Current. Now this will replace it. But you understood, right? I mean, you're getting the context.
Yeah.
Now Article 5. Again, I am not going here because this again India has not said I don't want anything of this to amend my treaties. So part 2 of the MLI had Article 3 to 5. So out of 3 to 5, India said 3 and 5 I don't want. Only 4 is there relevant for us. Okay. So I don't want to really spend time here, but this is again something which is trying to close the loophole for hybrid mismatches, which we saw, right? Taxation, non-taxation. So here you have options for companies to select. India said we don't want it also. This doesn't mention. Shall we move ahead? Part 3. Part 3.3 is on treaty abuse. Part 3 is treaty abuse, which is Article 6 to 11 of the MLI. Okay, as I said, there are only two action plans which are mandatory, minimum standards. They are called minimum standards.
Treaty abuse and mutual
improving dispute resolution. Okay. So now this has to go under the preamble of all the treaties. You cannot say that no, I don't want this under the treaties. Once it becomes a covered tax agreement, you have to include this. What you will include? Whatever language is already there, in addition to that you will include. This treaty is intending to eliminate double taxation with respect to taxes covered by this agreement without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance, including through treaty shopping arrangements, obtaining benefit reliefs provided in this agreement for the indirect benefit of the residents of the third region. Basically, the objective is not to give any treaty shopping benefit. So all your tax planning which I would have given, you would have given so far, saying that come make your investment through Mauritius, I will no longer be able to give.
How are those tax havens taking, like, they will be the one who would be maximum impacted by this?
Yes, they would be the
There's
ones.
no economic activity or substance to.
But there are no people also there, not significant people also there and everything. So they're just, maybe they're being run like, so like a lot of these tax havens which are there actually are British colonies. So if you take Cayman Islands, St. Kitts, these are all British colonies. So I don't know.
What will happen to UK tax practice?
I mean, that I really haven't thought about it. Yeah, but so someone has to gain, someone has to lose. It's not. So for the better good, it's happening. So there is one option to include developing economic relationships and enhancing cooperation. This also to include there. India said that it's already there in all my treaties, or at least the reason for entering into treaties is coming in my article section 92. There also it's given that I may enter into treaty for avoidance of double taxation, also for economic cooperation. So this is second option. India did not option. Additional option which is given. So this is Article 6. We are going to Article 7. Okay. So Article 7, it tries to include a principal purpose test. The article also, the relevant para is there in the next slide. We'll look at it. Here I've just summarized it. So here it's a mandatory, it's nothing optional. As I said, it's a mandatory again, this article also. But you have options of how do you determine the principal purpose test. You have options. So the article is mandatory, but in that region you have options. So you have an option of having a simplified LOB or a detailed LOB. India has opted for a simplified LOB. We can look at it what the simplified. Now India has said 36 of my treaties already have this. Did you know? 36 treaties of India already had a simplified LOB clause. Did you know that? You know what is an LOB clause, right?
Limitation of benefit.
Yeah, limitation of benefit. So India said 36 of my treaties already have under Article 28.2 or 29.2, whatever, already have something which says that this treaty benefit should be given only for residents or limited to residents of that country or something like that. Language is already there. So now that obviously those all will get amended because that articles India has notified. In addition to all other treaties where India doesn't have. So the compatibility clause has 3-4 scenarios. So one is in the absence of.
Is that because of that we started asking for this tax residency certificate? Is it because of the limitation?
Yes. So tax residency certificate for those countries, yeah, you have to consider that clause also while they get it, the tax residency certificate. But the limitation of benefit was not there in a lot of prominent India's treaties, including Mauritius, Singapore. So Singapore had a limitation of benefits specific, which was said that they had, which said that the company should have $200,000 expenditure, something like that. Specific was there, that was amended again in 2005. But there is a general limitation of benefit clause in India's 36 treaties. Now that all will get amended. Now what will get amended, we'll look at it. So, do you want me to read it? So the onus of proof has shifted to the taxpayer. Taxpayer has to prove that none of this, I am eligible to get this benefit. And what language, what important word which you see is the principal purpose. So if it is one of the principal purpose of the routing the transaction is, then you will not get it. So now this is just one article, one para.
That is what is enshrined in GAR also, right?
Yeah, correct. One of the tax
it's not primarily for tax.
So GAR, the whole argument whether GAR can override treaty or not. After these MLI, everything, it doesn't make any difference because both are almost at the same footing. Okay. Now, as I said, India has said that simplified limitation of benefit test, India has taken it. So what does that mean is that this is the simplified benefit of test. So for getting the simplified, for getting the TT benefit, you should be a qualified person. So what do a qualified person mean? Individual, state, political subdivision, non-profit organization, pension organization. These are all eligible. Companies whose shares are regularly traded on regular stock exchange, they are eligible. Entities with at least 50% of the shares held by other qualified persons for half the days in the 12-month period. So the enterprises, so individuals, it's very simple, and other companies traded exchange also very simple, because the companies will not just list in a country just for the tax treaty benefits. That's the thinking. But for others, other enterprises, at least 50% of the shares should be held by qualified persons. That means residents of that country should hold that company. So what happens in Mauritius treaty shopping? The US resident holding Mauritius company. So there is no Mauritius linkage at all. It's US investment is happening in India. So those will not be covered here. Now this could create an issue. Suppose there is a company, Mauritius shipping company, okay, or Mauritius trading company. Now that company got acquired for whatever reason, and a UK based company acquired it, or a Singapore there is a company. Okay, you have a company in Singapore. Now you are moving to US, you sell out the company to someone else and you go out. So that someone else could be a UK based company. Then it's a Singapore company doing business in Singapore, everything. But because of this, you will not get the treaty benefit. So seeing eligibility of any treaty benefit itself will become a very crucial thing on the going forward advice. So this could be a challenge. So for that they have given a solution or option.
100% subsidiaries of a foreign company.
Yeah. So then there's an exception created. So what it says is active conduct of business. So if that enterprise is in active conduct of business, then you should still give it, whoever it holds it. Now what does active conduct of business means? Again, at the next slide I'll decide. So there are three. So even if qualified person test is not met, these three tests are met, you can give it. One is, it should be an active conduct of business. Active conduct of business also is defined in the next slide will go. And then persons or equivalent beneficiary hold directly or indirectly at least 75% of the interest of the resident, at least half of the 12 months period that include the time benefit. So this is something little complicated basically, but if it's saying that you hold some other investment also in that company, some other kind of instruments are also there, preference shares is also there, equity shares is also there, but the threshold is higher, 75%, not 50%. So earlier we saw 50%.
When you said like qualified person, at least 50% of the holding should be by the...
Yeah.
Does it mean only direct holding or downstream further? Like two Mauritius companies own one... another
so,
Mauritius.
Yeah.
But that two companies are again owned by US.
Correct. So those two companies are not qualified persons.
But the third one,
No. So 50% should be held by qualified persons. If those companies are itself not qualified,
okay,
then this also doesn't become qualified. So you just by creating layers, you will not become a qualified person. You should. So here again, very important, they are given rights to competent authorities. So if the two countries decide, then you can take the benefit. So there will be a lot of usage of MAP procedures going forward for resolving a lot of disputes.
But MAP with US was going very slow, right?
Yeah, so now it will become faster, because if you look at it, there's a clear guidance that now they have said the MAP has to be resolved within 2 years, which is a very good timeline. So what is active conduct of business? a little complicated definition. So if I'm doing business in that country and that business is my substantial business, and what is substantial has to basically is seen based on facts and circumstances, that's what it says. Then it will consider as active conduct of business. So it should not be that I'm doing one-off transactions. So suppose, I'm just giving an example, a Singapore company is providing me some services, okay, or maybe other Singapore company which is not a qualified person is providing me some services. There should not be an agreement, you say fine, you pay to that company because I am not eligible for the treaty benefits because of the new definition. Now this company you route it through there and you take the benefit, and we will share that because the lower withholding will apply or no withholding will apply as per the treaty. So now the treaty also says that this company's business, this is not this main business or not a substantial business, then you cannot take it.
Something like a deemed international transaction sort of thing where you rope in the third party but still...
Correct. Yeah, so you are trying to basically structure it. So there's all the structuring they are trying to cut. I mean, they're saying you should not be able to structure it. So if you're not eligible, you cannot do through some other company the same thing.
But who will know that?
So the thing is, what will happen is here, the eligibility of that company to take the treaty benefit will be very important. So when the TRC has to get amended now, the tax residency certificate should now specifically say that you are eligible for tax treaty benefits under the
transaction wise or what do you call?
Or period wise. So the tax office of Singapore should give a certificate that this company is eligible for India-Singapore tax treaty benefits. Unlike the old law which says tax residency certificate is, I take it's fine. Whether for this treaty I eligible or not eligible, they are not bothered. I just give a tax residency certificate. The current law is, if you have a tax residency certificate, I have to give it, which is coming from that circular of 1998. There was one circular which went to the Azadi Bachao Andolan case and everything. Yeah, so that circular is not withdrawn. So as of today also that circular is a valid circular, and after that also there has been one more circular, couple of circulars. It says if TRC certificate is given, treaty benefit has to be given. Now TRC is there as per that country's law, because the current treaty says that country's law you have a residence or not. But now what we are saying the change in the definition. We are saying that for being a residence, for eligible, you should satisfy these addition conditions. TRC is no longer says that TRC is there. To get the treaty benefits, you have to satisfy these conditions. So again, there are exclusion also. There says active conduct of the business doesn't mean that you are just doing holding company or holding company, then you will not get it. You are providing overall supervision and administration to group of companies, you will not get. Providing group financing, making or managing investments, other than if it is a bank or an investment company. So only companies who are doing business in that country. So one simple thing is, it's a qualified person. Qualified person means it is held by people of those country only. Simple thing. Okay.
But these are additional conditions. Once if I'm a qualified person as per the first three conditions, they have to still look.
No. Once, so these additional things are
when I don't.
Don't. So that's why I said that I gave an example that genuine business may also get impacted. So that's why these exceptions are given, so that the genuine activities or genuine companies don't get impacted. So that was two treaty prevention treaty abuses, Article 6 and 7. Article 8, this again, so that was a mandatory article, it's over. But this is not a mandatory one. Dividend transfer transaction. This again is not relevant for India. Why it is not relevant for India? India, we don't have any because of this dividend distribution tax. Dividend taxation itself is not there. So all the treaties generally provide for a lower rate of withholding tax on dividends. So the objective here was to give a lower rate of withholding tax for a dividend only if that country, company was held by that company for a certain period of time. Otherwise, what will happen is someone just buys it for or holds it for a certain small amount of time and then takes the benefit. So that was the object, to stop those dividend transfers, structuring, which is also some of there in the India, which is in a domestic scenario also this happens, right? The capital gains in 93A or something section is there, yeah. So India again, this doesn't impact India. So India-Portugal treaty already has something that the lower rate of withholding will be given only if the company is held for more than 24 months or something like that. So other than none of the Indian treaties has anything else. But what this provision says is it should be held for 365 days for giving a lower withholding. I'll just reproduce the para here if someone wants to read it. So some company investing into India or something, it should not just, it should hold for a certain period of time, then only it will get the lower rate of treaty. Shall we move on? Again, not relevant for India. Article 8. Article 9. This is again in a lot of India's treaties, because India, out of those 93 treaties, 71 treaties already have this, which basically says that indirect transfer of immovable property.
Underlying.
Okay. So it is not indirect transfers of any asset which is there under the Act. It is still covering only immovable properties. So so everyone knows what's indirect transfer, right? It's basically transferring an Indian asset by transfer of some shares overseas. So maybe Indian company holds some land and property. This company is held by a Mauritius company. The Mauritius company, if I transfer the Indian asset anyway, get transferred. So this is narrow than what is there under the Act, because Act covers any asset. This is covering only immovable property, and 71 of India's treaties already have it. So again, I've reproduced the article. So we'll move on. Yeah. We have just 15 minutes, but I think we'll finish it off in 15 minutes. So Article 10 is on. This is again a triangular cases. You know what's a triangular case? Have you heard of triangular cases? Okay. So triangular cases are basically where more than one country is involved. 3 countries are involved. So take the example of India, doing a transaction with, you are in Malaysia, but you are a branch of a Singapore company. Okay, so I doing a transaction with a branch of another company. So it's a triangle case. Which treaty will you apply? Will you apply India Malaysia or will you apply India Singapore? A branch is active branch, they're doing business proper there. Which treaty will you apply?
India, Malaysia.
Okay, so the position is very clear that the branch never gets a treaty benefit, because treaty benefits are available only for residents. Now you are not a resident for Malaysia, so you will still apply. You are still a resident in Malaysia. You will not be resident only. You are still a resident of Singapore only. So you will apply the India Singapore treaty only. So a lot of loopholes were there here. What were happening? Singapore follows a territorial system of taxation. What basically that means, I will tax what you earn in Singapore. Outside what you earn, I will not tax. Okay, because if I tax outside, then I have to give credit everything. I'll keep it simple. So Singapore has a territorial system of taxation. So in this case, what will happen is, I will not give you treaty benefits of India Singapore also if the rate at which you are getting taxed in Malaysia is less than 60% of India's rate. So that is the intention, because a lot of this structuring was happening. Again, is it relevant for India? I don't think so. It's that relevant for India. So I'll move ahead, because again, not so relevant. This is again a savings clause which is there, which is not there in most of India's treaties. Basically clarifying that each country has a right to tax its source residents.
That was a given.
That's given, yeah. So that's not there in India's treaties, given only, but maybe they're just certain exceptions that for certain things the treaty will hold good, otherwise each country has. So what you will also see here in these articles, when you read the treaty, okay, there is certain amount of cross-referencing there. So if you read Article 28, it will refer to Article 10, except for Article. Here they have tried to remove those cross-referencing because they are trying to look at number of treaties at one go. So if they cross-referencing, then which treaty what? So they have reproduced the whole paragraph. So certain exceptions are except for taxation of so and so. So that language is there, not cross-referencing is not there in the cross-referencing with para numbers is not there, or article numbers is not there. That's the whole thing is produced, and that's why it's like to become a little lengthy also. This is a savings clause, not so relevant, so I'm moving it. Now we move to part 4. Okay, so part 1 was just the introduction. Part 2 was, what was part 2 about? Hybrid mismatches. Part 3 was on treaty abuse. So we looked at treaty. Now part 4 is about avoidance of PE. Part 5 is about improving dispute resolution. Part 6 is arbitration. India has again said we don't want arbitration. So India is not relevant, for part 6 is not relevant. Part 7 is again final provisions on how this article will, how this MLI will get implemented and all those things, how it will take effect and take into force, which already we covered. So basically we'll have to finish now part 4 and part 5. Part 4 is avoidance of PE status. Now here, the language, again a very small language change, which basically means that there's actually a video, there's a sound play in this thing. Shall I try it? I have a video, so let's see if we can play that thing. I'll see if the video plays, then we can. The video is not playing, so it will. But basically what it means is that if someone is playing a principal role in concluding a contract, then it will create a P. So previously the position taken was that if you're not playing a principal, if you're not concluding the contract, then the P doesn't get created. So you had lot of this Google, we started with this thing, Facebook, LinkedIn. They were billing from overseas and saying that there's no P. But because of that, now they are all moving to a reseller model rather than having agents or marketing service providers in India. So if someone plays a principal role, in the sense that principal role means basically, so previously they said he used to conclude contract, and the marketing or the agent here will say, I cannot conclude the contract, I am not authorized to do it, the contract will get signed and come overseas. But he's practically doing everything except for signing of the contract. So if someone is playing a principal role, then it creates a P for the foreign company. And it also says that if a related party is exclusively doing work for a related party, an Indian company is doing exclusive related work, again you cannot take it as an independent agent. Specifically states that. So basically all captive marketing service providers will get impacted. So I don't know if you have clients who are captive marketing service providers, they would really get impacted, and they should change their model to a buy and sell rather than doing marketing service provider and getting you billed at cost plus. So basically, how does it make a difference? Suppose a foreign company is selling 100 worth of goods in India. Now if you are a buy and sell, you would have earned at least a 5% margin and shown a 5%, or 105 would have get taxed. Now what's happening, if I work on a marketing service provider model, then 100 worth of goods are selling, but the cost of the marketing agent is only 10. So I get at cost plus 10%. So I get only offering tax to India, only 1. Vis-a-vis, if I were a buyer and reseller, I would have offered at least 5. So this, again, India has all the 93 treaties so India has notified everything. So this is what the actual language of the MLI
that
says.
particular clause is also amended in business connection, right? It is related parties.
Yeah, correct. So in business connection, they have introduced significant economic presence. So they have not really changed currently. They have introduced additionally the explanation, and said the significant economic presence also will be considered as a business connection. And significant economic presence, they have tried to target 2 things. They said someone has users in India, or maybe his so much customers, or the threshold are not yet notified. The thresholds, they have to come. They had issued a document or a circular recently to get public comments on threshold. So digital companies will have users. They will not have, take the example of WhatsApp. It has users in India. It doesn't really have sales in India, but it has users in India. So customers, users or something. So that we'll have to see when the notification came, but the concept is significant economic presence. So this is specific. That is general, trying to cover everything. This is specific. For commissioner agents, so this is, the heading itself, you see, artificial avoidance of PE status to commissioner agents or other similar statutes. These 2 paragraphs are there. Now there were 2 places where PE was getting misutilized. One is, I said, the commissioner agents. Okay, Ireland, Google, all of digital companies set up base in Ireland were building across European Union and just having a marketing agents in that country. So that all will get, if they get amended, that all will get impacted. The second thing where they were trying to get away was saying that their treaty itself provides certain activities exemption. Okay, so if you're like a lot of India treaties also say R&D services, if you're doing R&D, if you're doing, then it could be, it doesn't fall under the definition of PE. It's exempt, like the liaison office. So now those activities also, they have said, so like a lot of treaties have that if you have a warehouse for just delivering goods, it is outside the PE definition. Now warehouse for just delivering goods, okay. Now for a company where delivering goods itself is a major activity or the main activity, so the intention was to exempt activities which are preparatory or auxiliary. They are very insignificant activities. But what has happened is they have tried to look at it intentionally and said that it gives an exemption. But this is a main activity. It's not a preparatory or auxiliary. So they have said that it should be preparatory or auxiliary in character. So if your business is that I am doing a online e-commerce business, delivering that itself is the main activity. I really cannot say that that's a preparatory activity. So that they have specifically said that it has to be preparatory and auxiliary in character. And then there is also anti-fragmentation rules, which says if a related party is doing something, you have to look everything at consolidated and not what each branch or each company is doing. So it's not that you set up 3 companies and or the 3 branches and one is doing only sourcing customer and saying that it's not concluding contracts and again get out of the PE. The other is just delivering goods and saying that it's just delivering goods and get out of the PE. Okay, another is just doing some research and say that okay fine, they are doing only research. So you have to look at everything consolidated. So that's what it says, that you have to look. Again, PE, because India has all the treaties has PE exemption, so this all will get amended now. India has notified already that. So this is what the substantive provision article is there. I think we'll go ahead. Yeah. Maybe you can read it later also. The paragraph is also there, which is anti-fragmentation rule. This is the anti-fragmentation rule. Okay, no, sorry. So this is not an anti-fragmentation rule. This is basically the period when you, because okay, sorry, this is anti-fragmentation rule. Closely related enterprise is doing something else, you cannot look at it standalone, you have to look together. And then they are splitting up contracts also. So certain lot of treaties India have certain activity carried out for certain period of time. Like if you're doing construction contract, it says if you're doing up to 90 days, it's not PE. So that also is said you cannot just split the contracts, give it to 2 different companies, 190 days, 190. So you have to look at together if they are forming. So there are a lot of actually judicial precedents on it. There was one very, not recent, but there was one case I represented in the Hyderabad tribunal, was on similar thing, where the foreign company was providing certain mining services, mining equipment supply services, but the period was not extending because they said the supply happened in year 1, the maintenance services happened in year 2, so it was not really for creating a PE. But if you look at it together, the period, then it was, so in the amended rule, it would not get that exemption. So the duration also has been reduced to standard 30 days, I think. And then Article 15 gives what do you mean by closely related person, because this word closely related has been used number of times in the earlier 2 articles. So this is the last portion which we are going to spend. As Article 16 is mutual improving dispute relations, the part 6. Again, this is mandatory. You don't have a choice. So this again, India has. So in India has again here the option is given that you can do it bilaterally. Also, you can amend it. So India said we will amend it bilaterally and not. So one is that they should get a 3 years time period. So some of the India treaties had 2 years time period for applying for a MAP whenever the final order comes. So they should make it standard 3 years. And then there is also, so that has to become 3 years. And the second thing is, as I said, India has not really implemented what is language. It said that bilaterally we will allow this thing. So India said we'll allow it, but not really amending the treaties. Because amending the treaties, here there is a process that 3 years you have to give, 2 years you have to resolve it. So there's time fixation for both the things. India said we don't want time, we'll amend it bilateral. So India, I think, is okay with the 3 years, giving a 3 years time, but not saying that it has to get resolved in 2 years. Because if it doesn't get resolved in 2 years, it will go for an arbitration. So arbitration is, India said we don't want arbitration. That is a mandatory arbitration. So you have one country, there will be an arbitration panel of 3 members. Each country can recommend one member and one member from other country, and then it becomes arbitration panel. Corresponding adjustments. This is what I was saying, that one country gives, another country gives an adjustment. This is where secondary adjustment comes in. So this has been now come up in all of India's articles. It will come. So India was not accepting bilateral APAs for a lot of countries, saying that the Article 9.2 is not there. So now India can accept bilateral APAs for all the countries, including US. So India said we don't want arbitration. So that was the last part, and after that there is how, when, and how it will get in effect and all those things. So we have come to the close, but if there are any questions, we can take it up. I'm there for some time, offline also we can discuss. So, in summary, very important thing is, going forward, whether the other treaty benefits are eligible or not, that itself will be a question to focus on. So currently we directly go into the substantive provision and see what is the withholding tax, beneficial rate, and all those things. So that's not relevant now. Whether you can go to the treaty or not itself will be the first important hurdle to cross.
You have to go beyond the transaction.
Yes, you have to go. So that hurdle has to be crossed before you really apply the treaty. Now currently we don't even focus and just say, oh, this country is of that country, just apply the treaty. So one is that, so all the treaty shopping, everything will be there. Second thing is on the P amendment. So all the marketing service providers models, preparatory and auxiliary exemption, liaison officers who are taking treaty benefits. So in India's case, because of lot of restrictions on foreign branches, how they work in FEMA, Companies Act, everything, not too many companies have opened branches. Generally they come through a company only. So again, not much impacted, but yeah, those companies who are doing as marketing service providers models, they are getting impacted.
How many of the companies are, apart from what you said, LinkedIn and Facebook, is there other reorganization happening in India?
So if you look at this whole business of digital business is kind of monopolized, not monopolized, but what word do you use, where you have only few large companies, oligopoly or duopoly, I don't know what word you use. So they are very, very limited companies which are, the scale is unimaginable. So if you look at it, Google has an advertisement revenue of $70 billion, which is put up all the publishing companies in the world and all the TV advertisement companies in the world together. They don't have $17 billion revenue. So other companies could be there, but they are very small, very, very small. So they have these few large giants which are there. So like LinkedIn got acquired by Microsoft for $27 billion. So it was just a $2 billion turnover company and it got acquired for $27 billion. So there are not many companies. There are a lot of few companies who are the scale and size. At least I have not really seen. There are very, very small companies there, but they don't do that kind of structuring because for them maintaining the structure itself is a cost. So they would rather pay off the taxes. And
have you seen the outbound structures like this, like from India?
Oh yeah. There are a lot of companies who try to do outbound structures, particularly Indian companies who try to do business in Africa. They set up base in UAE, and UAE again has very strange rules. So if you set up somewhere in UAE, there's no taxes. So you set up, you should have a local partner, or then you set up they have set up this free zones where you don't need a local. So you set up in a free zone where actually you set up because you set up there as office, but do you have people there? Nothing. I mean, the operations will happen in some other countries. There is nothing significant that happens, but yeah. So whether they are eligible for treaty benefits or not is they will not be eligible after this MLI gets implemented. Any other questions? Anyone has any point of view? We are exactly at 8:04, 8:03. So we have time till 8:30, but yeah, we don't have to stretch it. If everyone has understood what the objective is there, I think we can wind up. Yep, we'll wind up.
Yes.
So thank you so much.
Before we wind up, Madam, it would better if you present in the guest of
it's very difficult to understand what is the reality. They are so biased. One is the physical and another is the mental. There is a viewer.
PwC people, they work with G20 symposiums.
Okay.
I've been to
So you practice also or just ask about
this is full time, it takes a lot of effort.
but
I only said that it's a good project. They got a conference and was invited to G20 and World Bank also has invited.
Something different.
Thank you so much.
really
Good.
very clearly explained. You are sharing this presentation or it is your private?
No, I can share. There's nothing private. I have
It
this.
will be available on Instagram website.
I have not sent it because I just finished it just yesterday.
But you can give your email ID if you
You
prefer.
want I can make it.
Yeah, you just
You want my card? Yes, I'm just dropping it.
PwC is working on behavioral insight.